Hello, everyone. Welcome to this month's monthly market update. My name is John Pasalis, President at Realosophy Realty in Toronto. For those of you who aren't familiar with us, I'm the president owner, have a brokerage in Toronto, and our agents help people buy, sell houses across the GTA. Speaking of our agents, several of them, Gus Papayano, Peter, Carlos, and David McMahon, are going to be hosting an upcoming buyer workshop at our office in a few weeks. We'll put the link to that Eventbrite page below. But yeah, I like to host these monthly webinars to just kind of give a brief update on what is happening in the market, what are the latest trends, and as always, we're going to have David LaRocque join us, who is our regular guest, talking about the latest mortgage trends as well. So as always, if you have any specific questions, please post them in the chat. We're going to do our best to kind of go over them, either myself or David. It's of course one of the goals of this live update is to kind of answer your questions as we're going through some of the latest trends. Anyone has any specific questions, please feel free to sign up for a consultation, movesmartly.com/meetjohn, or you can send me an email at askjohn@movesmartly.com. And Urmi Desai, of course, is always from Move Smartly, is always on here, keeping an eye on your questions. So as always, I'm going to go through some of the latest trends, first in the low-rise housing market, and then kind of follow up on the condo market. So when we look at some of the statistics for what's going on in the market for houses, I'm going to first kind of just look at detached homes because it's the biggest segment of low-rise homes. And when we look at the number of sales for the month of October, we're at a record low. I mean, we haven't seen, like, going back to 1996, which is how far back the Toronto Real Estate Board's data goes. Last month was the lowest number of sales on record for detached homes in the GTA. And again, part of this, of course, is, or a big factor of it, is the unbelievably high interest rates, which are impacting affordability, and of course the high prices as well. These prices were not set at high sixes interest rates, so that's weighing on sales. Now, when we look at new listings, just about 6,500 for the month of October. That is again in line, I'd say, with the 10-year average. So we're seeing new listings pick up. At the start of the year, new listings were at record low. They're coming back to normal. But the big issue right now at detached homes is the lack of sales. When we look at the inventory, so it's the active number of homes available for sale, for the month of October, we're about 8,500, just above the 10-year average. Again, it's high, but it's not insanely high. But again, it's the low sales that are impacting the market. Now, when we look at the months of inventory, which is basically this 8,000, the number of homes that have sold divided, so the number of homes that are available divided by the number of sales in the month, it tells us how long, in theory, it would take for the market to clear if no other homes got listed. Low-rise houses are just under 4 months of inventory. We're kind of really close to this cusp of a balanced market. We're in sort of a balanced market. As we inch higher, we start getting into kind of buyer's market territory, which might put more pressure on pricing. Speaking of pricing, prices have dipped since the spring. So we're down basically about 100 grand since the spring. But when we look at prices year over year for low-rise homes, they're basically still up about 4%. So even though prices have dipped, we're a little bit ahead of last year. Average price for low-rise home right now is 1.36, which is still insanely high. But again, I think it's interesting to note that we're despite the decline and despite the sluggish sales, we're still up a little bit over last year. And I think the key trend for low-rise house prices right now is it looks like there's some stability in prices. So like I said, prices dipped quite a bit from the spring to the summer as people pulled out of the market. But we're seeing, some stability right now in prices, and we'll see how long that sticks. Moving to the condo market, Condo sales are also unbelievably low, not quite a record low, but the lowest in 20 years. There's about 1,300 condo sales. Typically there's about 2,100 condo sales for the month of October. So again, the sluggish demand in sales is really kind of impacting the market. Now, when we look at new listings, this is where things are a little bit different between the market for detached homes and the market for condos. New listings were about 4,600. Average is about 3,800 for the month of October. And last month was the second highest number of listings for the month of October on record. The only higher month was in 2020 we had this kind of COVID boom as people were rushing to sell their condos. So aside from that, we basically have a near record high in new listings. And this has pushed the number of active listings up quite a bit. So there's about 7,000 condos available for sale in the GTA. And there are usually only about 4,800 on average for the month of October. So we're seeing a lot more inventory. And of course, this is kind of contributing, and with the combined low sales, months of inventory for condos are about 5.5 months. And they're rising a bit more rapidly than we're seeing for houses. And again, I think this is largely because we're seeing, I'd say across the board, we're seeing more investors exit the market. And condominiums have a lot more investors than houses. And this is partly what's contributing to the increase in the number of new listings in the months of inventory. When we look at prices for condos are actually down about 2% over last year. They're down about 50,000 since the spring. But relatively stable. I mean, inching down a little bit more than detached and low-rise houses. So I'm going to kind of briefly touch on a few trends. I posted in my report, which you can find at movesmartly.com, that I think are important to keep in mind. When we look at the housing market, I mean, for those of you who saw, I did an interview with Robert Kapchik this week. We published it from BMO, and he talked about how the trends in the housing market across Canada are actually completely different. Ontario or Southern Ontario is getting hammered the most. Eastern Canada is doing well. Calgary is doing well, and some other markets are just stable. It's really Southern Ontario that's getting hit the hardest. So in the same way, we can expect to see this variation across cities and regions in a country. The same really holds when we look at the dynamics in different regions or municipalities within the GTA. And in particular, when we think about even the different house types in the GTA, what's going on with houses and condos. So what I'm going to look at now and talk about are how have the dynamics changed for houses and condos across the 5 regions in the GTA. And the 5 regions are Durham, Halton, Peel, Toronto, and York. So when we look at the change in sales, there's a couple of interesting trends. I mean, firstly, most regions and house types are within 5% of last year's sales volumes. And that's because last year was also a terrible year. Sales had plummeted last year because in 2022, buyers basically started pulling out of the market. When the Bank of Canada started hiking rates, prices fell, buyers kind of moved to the sideline. So when we say where most regions are close to last year, I mean, that's not necessarily a good trend because last year was a terribly low year for sales volumes. The interesting thing is, regions like Peel, so Peel condominiums have seen the biggest decline in sales. Sales are down close to 20% for condos in Peel. And then houses in Halton region, which is basically where Oakville is. Sales there for houses are down about 10%, and that's the biggest draw for low-rise house sales. Now, again, the big impact right now that we're looking at the market is this increase in inventory, and especially in particular relative to the sort of the balance in sales. So sales are basically at last year's levels, which are still unbelievably low. but more people are listing, which is driving up inventory. So when we look at the year-over-year increase in active listings, there are a number of important trends. Number one, almost across the board, all regions and house types have seen listings up over 50%. The only exception is Halton condominiums, which are up in the high 30s, but every other region has seen the number of active listings just skyrocket 50%. The other interesting trends are for pretty much all of the suburbs, low-rise house listings are increasing or increased faster than condominiums. So, in Durham, roughly, about a 60% increase in condo listings, whereas it's over 80% for low-rise homes. And that's consistent across the suburbs. The only region where new listings for condos have outpaced low-rise homes is in Toronto. And again, I think largely because far more investors, we're seeing more investors wants to deleverage. And that's why we're seeing some of those dynamics. But, active listings is an important metric. It is not necessarily the most important one. Again, I think thinking about the months of inventory is more important because the months of inventory is effectively a measure of the balance of the market. It takes into account the inventory, the supply, so the active listings, and the sales, which is the demand. So you kind of have the demand and supply in one metric. And when you see here is, and I think it's an interesting result, when we look at the months of inventory, Durham region, even though it had the highest increase in active listings, it still has the lowest months of inventory, and I'm speaking for low-rise homes in Durham, across the entire GTA, across all house types. And again, this is largely probably driven by the fact that inventory levels were so low last year. I mean, Durham probably had a very, very low volume of active listings, which is why it's seeing a big increase, but the market is still moving relatively well. Despite the increase in active listings, the market is kind of a little bit more balanced than some other regions. So that's one important thing to note. The other, I think, interesting kind of trends are pretty much across the GTA. Inventory or months of inventory for condos is higher than it is for low-rise homes. And the biggest gap here is really in the city of Toronto. I mean, city of Toronto, low-rise houses have about 3 months of inventory. Condos are just under 6 months. And again, I think this is important because when we see some of these differences in dynamics across housing markets, it's because there's just different things going on. There's just far more inventory of condominiums, far fewer showings. And this is what these stats say. Condos are going to see far fewer showings, far less activity than low-rise houses in the city of Toronto. Similarly, even if we compare the city of Toronto houses, low-rise homes, to Oakville or Halton region's low-rise homes, the fact that Halton has 5 months of inventory compared to Toronto's just over 3 months tells you that the market is far more sluggish. In Toronto, we're still seeing agents, some of them price low with multiple offers, selling for over asking. This does not mean necessarily that the market is crazy. It just means that the market's a little bit tighter. So the nicest product is still going to get multiple people interested. And again, this is a function of the fact that there's still only about 3 months of inventory. Whereas in markets like Halton, where there's just far more inventory compared to sales, the market's going to be slower. It's going to take longer for your home to sell. So, as a buyer, I think it's important to understand these regional differences, and similarly as a seller. Moving on, when we look at the months of inventory for low-rise homes across the GTA, just to kind of expand on my last point, there is a ton of variability. I mean, regions like King, Caledon have the highest. I'll say that these regions generally have a higher months of inventory. They tend to have more expensive houses that sit longer. But even today, I mean, the gap between them and most other regions is quite high. This is followed by East, so King and Caledon have 7 to 8 months of inventory. Regions like Aurora, Halton Hills, Oakville are pretty much just under 6 months of inventory. And when we look at some of the most competitive regions, Markham, Ajax, Clarington, a lot of Durham region, quite frankly, in the city of Toronto, they're anywhere from high 2 months of inventory to about 3 months of inventory. So again, these differences are going to basically give you some clues into which regions, if we think about distressed regions, regions with far more inventory are going to be a little bit distressed. The only caveat to that to keep in mind is when you're looking at some of these luxury areas, because they always have more inventory. They always take longer to sell. But if you're looking at, most normal markets, having 6 months of inventory is going to be a region that is going to be far more sluggish than one with 3 months of inventory. And I'll wrap up the charts here before bringing David on with a look at the year-over-year change in average prices. So, interestingly, again, when we look at low-rise prices, they're pretty much up across all 4 regions except for Halton, which is pretty much flat. But in Durham, Peel, Toronto, York, they're up anywhere from 2 to about 5% in the city of Toronto, just over 2% in Peel. So despite the decline since the spring, we're still up a little bit over last year. When we look at condominiums, 3 of the 5 regions are actually down. York, Toronto, Halton, and Peel and Durham are still up a little bit. So again, I think the important key thing to think about is that in a shifting market, whether you're buying or you're selling, I think it's important to understand the local dynamics in the region that you're looking at, because if you're selling, it informs how you sell, what's the price at, how greedy or aggressive to be or how not to be. And similarly, when you're buying, it kind of gives you some clues into which areas are sluggish, which areas are seeing way less activity, and which markets might see a little bit more pressure and distress. So I think it's important to think about these regional differences as a buyer or as a seller when you're navigating the market. So I don't know if you have any questions, Urmi, before I bring Dave on, actually, if we had anything.
Hi, John. Sorry about the delay. I think let's hear from Dave, and then we'll return because I'm seeing a few related to interest rates in the market.
All right, Mr. LaRock.
Right on cue.
Perfect timing. So David LaRock, Integrated Mortgage Planners, writes an excellent column on Move Smartly every week. For those of you who don't follow it, has a great look at what is going on in the world of mortgages, interest rates, monetary policy. So every week we get a benefit of a crash course on what the heck is going on in the economy and how it impacts interest rates. And once a month, we have the pleasure of having David join us as well. So thank you, David, for taking the time again this month.
My pleasure. Good to be here.
Let's kick things off with, your latest post. You kind of touched on some of these early signs that fixed rates might be dropping, but not dropping a lot. So maybe unpack kind of what's going on there, why that might be happening and why it's not as significant as maybe, buyers or mortgage borrowers might have hoped.
Sure. Well, it's funny, John, when you write about what's happening with rates in real time, sometimes a post I wrote on Monday, especially in a volatile market, is almost out of date the following day. And that's probably true this week. So just to bring anyone who doesn't follow this stuff like I do up to speed, the U.S. Federal Reserve a few weeks ago held its policy rate steady. That was a key milestone for the bond market. And again, Canadian fixed mortgage rates are priced loosely off of Government of Canada bond yields, and Government of Canada bond yields ride on the tail of U.S. bond yields. So as much as we write about what the Bank of Canada is going to do and how Canadian bond yields move, the Bank of Canada is much more independent from the Fed than the Canadian bond yield market, the bond market is of the U.S. bond market. But many times, most of the time, a big move in Canadian bond yields can be explained by taking a look south of the border. And that was the case recently. So bond yields in the U.S. reacted positively. There was a rally, which caused yields to fall. Prices went up, yields went down when the Fed held, because there was a lot of speculation that the Fed would continue to increase. And when the Fed held, in its policy rate language, it did the usual warning it'll raise again if needed, but it was seen as kind of a semi-dovish commentary. And the reaction of the market was to sell off, was to rally. And basically people bought bonds because they thought the rates they can get today are going to be better than the rates they can get tomorrow if the economy slows and the Fed starts cutting. And so everybody was buying, and that pushes yields down because the more demand there is for bonds, the higher their price goes and the lower the yields go. So yields, after rising all summer, I mean, they rose by about 1.25%. I'm talking about the 5-year bond yields, but realistically, anything in the middle of the curve, 5-10-year yields. The financial markets look at 10-year yields. If you're in my business, you look at 5-year yields because most people want 5-year fixed mortgage rates or something close to that. So we really pay attention to 5-year bond yields. Again, loosely as a proxy for fixed mortgage rates. So they went up by about 1.25% over the summer. It seemed like they were rising every week. It seemed like they'd never start falling again. And then finally, when the Fed a few weeks ago said that it was pausing from additional rate hikes, the market loved that, and bond yields dropped by, in total, over the span of a few weeks in the lead up to the Fed meeting. And then after the Fed meeting, they dropped by about 50 basis points. Fed Chair Powell, U.S. Federal Reserve Chair Jerome Powell.
So 50 basis points, just to clarify for people, is just basically 0.5%. I mean, just another way of kind of saying that in bond lingo. So go on.
Thanks, John. I have to keep reminding myself that not everybody's an industry insider, and that sometimes I have to use more standard terminology. But thanks for that clarification. Yeah. So bond yields fell by about 0.5 point, and fixed mortgage rates only went down by about 0.2%, 20 basis points, and the major banks didn't cut at all. And the questions I started getting from borrowers who have existing approvals in my pipeline is, when is my lender going to start cutting my rate? Why aren't rates falling? And so when I wrote the post on Monday, it was basically to answer that question. A lot of times, since I write a weekly post, if there isn't a major economic data release, or if there isn't major news that sort of demands that I acknowledge it, I look more broadly. And in weeks like that, the question I answer most readily is, what are people asking about today? And the question I was getting when I wrote the post last Sunday was, people were saying at the end of last week, bond yields are dropping. When am I going to see lower rates? So it was to try to explain why to remind people, first of all, that lenders take the elevator on the way up when they raise rates and the stairs on the way down when they cut. That is a truism as old as time. But also, there was some background that people needed to be brought up to speed on. So long story short, when U.S. Fed Chair Powell saw that the bond yields were dropping so steadily, he didn't like that, because even though they decided not to raise, they still want high rates to slow the U.S. economy, because they need a slower economy to bring inflation down, and inflation is still too high. So at a press conference, when he was making a speech, he said, rates are going to have to stay high for a long time. We might well have to raise again. He gave a lot of hawkish commentary, and the bond market immediately responded by going up by 15 basis points. So we fell by 0.5. We went up by 0.15. And in defense of lenders, they look at a market like that and say, let's hold up, because basically we don't know where rates are going to settle. And by the way, we're making wider spreads in the meantime, so we're getting paid to wait. In the post, what I talked about, John, is the fact that right now we're at a turning point in the interest rate cycle. We don't know when rate cuts will materialize, but the market has basically agreed on the fact that probably more rate hikes aren't coming. If they are, we might get a 0.25 point. It would take something happening that hasn't happened yet, like oil prices spiking, or the inflation data coming in much higher than expected. Right now, the bond market is priced in the fact that they don't expect investors don't expect rates to rise anymore. But we've still got the tug of war, as is often the case at turning points in the cycle, between our central bankers, who are saying rates have to stay high for a long time, inflation is stickier than expected, people should be prepared for high rates to last, and should be ready for us to raise again if we need to. The bond market's saying, yeah, we're forward looking. We know how high rates are. We see the economy slowing. In the U.S. in particular, we see saving rates declining, credit card rates going up by a lot. People are tapping back into credit. That means that basically there isn't as much buffer in the system as the U.S. consumer goes. So too goes the U.S. economy, and inflation, U.S. inflation, and U.S. Bond yields. So all of this right now that's happening is a tug of war, and at turning points in the cycle, there's lots of volatility as the disagreement rages between what the bond market thinks is going to happen and what language the central bankers are using. So lots of volatility right now. That was the warning in my most recent post. The volatility in the summer meant that bond yields kept rising and rates were going up. The volatility now is generally working in the favor of borrowers because rates are falling. Interestingly, on Wednesday, we got the latest US CPI print, or sorry, on Tuesday, and it came in lower than expected, and bond yields shot back down again. They dropped by about another 20 basis points, and there's now plenty of air under Canadian fixed mortgage rates, and we should see more cuts. Again, they're going to take the stairs, so don't expect that when bond yields fall by 20 basis points, you're getting 20 basis points worth of fixed rate mortgage cuts, but they have settled at a lower level, and I would be surprised if by next Monday lenders hadn't cut rates. The most aggressively priced mortgages will probably fall by another 10 or 15 basis points. The major banks have to play catch up. They could be dropping by a quarter point or more imminently because, again, the market reacted to that US CPI report. It came in a little lower than expected, and it was probably an overreaction, but typically the bond market shoots first and figures out the questions and the answers later. And right now, the bias in the market was priced for sticky inflation, rates higher for longer. And anytime we get economic data releases that call those assumptions into question, the bond market reacts immediately, in this case, by buying bonds today because they think that tomorrow the rates on bonds will be lower, and that pushes yields down. And that's the action that we're getting today. But it's very volatile right now. And again, you write a great post on Monday, and by Tuesday, it's out of date.
That's that's super helpful. And I think because a lot of people see these dynamics, they hear about yields falling potential, at least maybe the people who are on Twitter. If you're not on some of these platforms, if you don't follow these trends, you're not going to hear that. But it's great that you kind of unpacked how volatile it is. I mean, and really just based on one sentence by the Fed chair that triggers the market, one CPI result that is a little bit more favorable than expected causes bond yields to dip. And I did an interview I mentioned earlier with Robert Kavchik from BMO. I mean, and even he said, I mean, things could turn on a dime. If the next CPI print is higher, all of a sudden the markets are more pessimistic and rates go up, and the longer, higher for longer kind of kicks in a little bit. So super interesting. Now, in your post, I think you kind of touched on sort of the outlook for bank rates, what the market is expecting in terms of, the bank's potential first cut, whether that's early in 2024, whether that's later in 2024. I don't know if you can kind of touch on that. Obviously not, if you want to give us your crystal ball prediction, that's great. But, what is the market looking at in terms of, basically policy rate changes?
Well, lots of volatility there as well, John, in terms of what the futures market is pricing in as far as when the next rate cuts are coming and how many we're going to get. Before the CPI release this week, the US bond market was expecting the Fed to start cutting in June of next year. Now they're pricing in April, May. They're pricing in 4 quarter point cuts instead of 3 quarter point cuts. It really is quite volatile. It's a bit of a fool's errand to try to predict when rates are going to move, because there's a lot of things that could happen between now and when they ultimately move that change, the outlook. Everybody had a really strong view on inflation being transitory, and then Russia invaded Ukraine, and energy prices went through the roof, and food prices went through the roof, and a whole new era of inflation began. And unfortunately, a lot of smart people had very sensible thoughts about inflation that went out the window once the Russia-Ukraine conflict started. We've got conflict now in Israel, and that can affect oil prices. Any Middle Eastern conflict is going to, it hasn't yet, but it certainly has the potential to. And if oil prices go up, that'll push up inflation. Oil prices are so pervasive in terms of how they affect overall prices that could significantly change. But right now, I mean, in the middle of all this volatility, with all the stuff flying around, here's one thing I am confident of. I think the Fed and the BOC have a strong over-tightening bias. I think they want to drive a stake through the heart of inflation, and they will probably not be convinced that has happened until the market has long thought that inflation was coming down. So I think the last people onto the we've done enough, we can start cutting rates boat will be the central bankers, the guys with their hands on the lever. So I think in all of their language, they want to err on the side of over tightening. I think they're a lot less worried about what happens if they stay tight for too long than if they go loose too early. And there's lessons from past history that say that inflation can rear its ugly head if you're not careful and you don't drive a stake through the heart of it. In the 70s, if you look at a graph of US and Canadian inflation, we had a spike and then it came down and then it went higher on a second spike. And that's a lesson they haven't forgotten. So I think they have an over-tightening bias. And I think the longer they keep rates higher, this is what I'm confident of. The longer they keep rates higher, the more they're going to have to cut when they do start cutting. In other words, when they drive a stake through the heart of inflation and they've kept rates high for longer, the economy is going to need a lot of stimulus from rate cuts, and it's going to need more than a few. It's going to need substantial rate cuts. So I think if you've got the patience to wait and you take a variable rate now, I think at some point over the next 5 years, because most variable rate terms are 5 years, certainly the most competitively priced variable rate terms are 5-year terms. I feel pretty good that, if you're either going to get cuts in the middle of next year, like the market is currently pricing in, or if it takes longer than that, I think you're going to get more cuts later, and you might end up saving more money because ultimately the delay in the cuts brings more cuts ultimately. And again, this is all prediction stuff. My opinion, in $2 a good inning, want a hot cup of coffee, but I follow this stuff quite closely. And I think it makes sense that, look, there's been a lag effect, right? People thought the economy would slow as soon as rates rose. The central bankers know, based on all their history and their analysis, that it can take up to 2 years for rate hikes to exert their full impact. We're just now in the middle of 2 years out from the middle of the rate cuts that happened. So the lags are disappearing and the impacts are more and more evident. And I don't think we're anything close to the full impact of all the rate hikes. I think there's a lot more slowing coming, and more than people think. But how long it will take for that to impact inflation, I don't know. And by the way, if inflation stays high and the economy slows, too bad, so sad. The central bankers care about inflation. That's their mandate, especially the BOC, because while the US Federal Reserve has an employment mandate and an inflation mandate, the Bank of Canada only has an inflation mandate. So if they're doing their job, they have to focus on inflation. And if we're lucky, when the economy slows, inflation comes down. But if we're unlucky, the economy will slow, inflation won't come down. The Bank of Canada will say, sorry, guys, we're not getting back to 2% target by cutting right now, and we gotta endure more pain.
That's interesting. Let's turn. You kind of touched on the 5-year variable, and maybe we can kind of chat a little bit about this, because in your latest post, you kind of talked about, the most common kind of options buyers are leaning on now are either, say, 3-year fixed roughly, or 5-year variable kind of is the most common. So can you walk us through, roughly the difference, like the interest rate difference, like on a 3-year fixed and a 5-year variable, just so we can understand kind of what the numbers look like, just ballpark. And I'm putting you on the spot right now.
Yeah, sure. Well, if you're conservative, then I think the 3-year fixed rate makes the most sense right now. Bottom line, I wouldn't be locking in for 5 years. I know that's typically the more popular. That's the more popular option based on history, but the reality is we've just had the biggest spike in rates we've seen in 40 years, and locking in for an extended period to me sets people up to be disappointed in the second half of their term, especially with some fixed rate mortgages that come with much higher penalties. For example, the major banks use their posted rates when they calculate fixed mortgage penalties, which can increase them by 4 or 5 times and make them so astronomically high that it will never produce a saving, no matter how low rates go, to eat a penalty from a major bank, because the penalty will always outweigh the savings. Or if that isn't true in every case, it's true in almost every case. So to me, I think shorter duration makes sense if you want to go fixed and if you're conservative. 1 and 2 year fixed rates are quite a bit higher than 3-year fixed rates. You're paying a premium over 3-year fixed rates of anywhere from 0.5% to 0.75%. And the risk you have if you take a 1 or a 2 year is that your mortgage comes up for renewal before rates have dropped materially. So you end up paying a premium and you have to come back to the market and reset your rate before they've had time to really fall. So 3-year fixed to me seems like, I think it's pretty reasonable to believe that in 3 years rates will be lower. If you take a 3-year fix today, you're getting a lower rate in exchange for the risk that rates do fall more quickly and you end up with, say, a year left on your term wishing you were up for renewal. But again, if you're conservative, you're not trying to hit the bullseye. You're just trying to keep from getting smoked on either, on either the top or the bottom outliers. And given the premium you pay for 1 or 2 year fixed rates today, I mean, it's not a premium I would pay. I think that sweet spot, that middle of the fairway, I call it, is the 3-year fixed rate. That said, if you ask me which option I think will save the most money over the next 3 years or 5 years, I think variable rates are a better bet. And again, I'm basing that on lots of research and my heartfelt opinion, which is all it is. But I think the beauty of variable rates is when the Bank of Canada starts cutting, variable rates fall right away. And I do think that we're going to end up in a scenario where either the bank starts cutting in the middle of half of next year, like most of the market thinks will be the case, or if they don't start cutting in the middle of half of next year and it takes longer, when they do eventually cut, I think they're going to cut by more. I think because the economy is really going to need that stimulus. So if you agree with that logic, then taking a rate today that's a bit higher, and you're going to pay a premium of about, it depends, but right now today you're probably paying about 0.5% more if you go with a 5-year variable versus a 3-year fixed. But you're benefiting the first day rates start to fall, and to me, if you're aggressive, you're willing to pay a higher rate initially. You're also willing to tolerate the risk that maybe the rates keep going up. If they go up much higher, I don't think it'll be more than a 1/4 point. I mean, it's hard for me to imagine a scenario where we go up by any more than that. Those scenarios exist, but they're outlier scenarios. I mean, if you think Mars is going to hit Earth, take a fixed rate, right? If you're worried about that, don't go variable. And also, certain borrowers can tolerate a higher, seeing their payment rise, and some people are right to the line. The people right to the line should be fixing their rate and deciding on the term that fits best. But in answer to your question, John, for conservative borrowers, I like a 3-year fixed rate. If you're willing to be aggressive and you're willing to accept the risk that you could end up being wrong, I think the odds favor a 5-year variable rate right now. Certainly with where we are in the cycle, when you look back historically, when rates peak like this, variable rates typically do win out in the coming years.
So just to unpack that quickly before I bring Urmi on. So you're basically set up fixed 5-year variable rates are about 0.5% higher than a 3-year fix, right? So if we just put some numbers to that, you can get let's keep the numbers simple. If you can get a 3-year fix that, 6.5 or 6.25 or something like that, you're paying 0.5% more for a variable rate. And the reasoning for that is you would do that because you think over the next year or two, the bank will cut more than 0.5%. So over your entire, say, next few years, you're going to be better off than paying kind of the 3-year fixed rate. And that's kind of the rationale for why people are potentially going variable, because they think the cuts will exceed this 50 basis point difference that they're paying now over the next year or two, correct?
Yeah, the other thing that matters, John, is when those cuts materialize. If they don't show up for 2 years and you pay that 0.5 point premium for 2 years, you need rates to fall by more than that when they do start to fall. Yeah. But right now, the market thinks that by the middle of next year, rates will be 0.75% to 1% lower. And if that's true, variable rates will win out. If I said to you, you have to pay 0.5% more over the next 12 months, but then for the following 24 months, and remember, it's a 5-year variable, so it's actually 48 months, you're going to save, your rate's going to drop by 1%. you'd take that bet all day long, because you're spending 2 years at half a point under the fixed rate and only 1 year above it. Obviously, no one knows exactly what the timing will be. Right now, the bond market is pricing in cuts in the middle of half of next year, and in the neighborhood of 0.75% to 1%. So if it works that way, the math favors the variable. But again, some borrowers are conservative. I concluded this week's post by saying, my bet is you're probably going to save money if you go with a variable, but you're probably going to get a better night's sleep if you go with the 3-year fixed rate. And you can't put a price on a good night's sleep.
That's fair. Awesome. Urmi, I don't know if we have any kind of questions for myself or for David.
We do, but you're making my job superfluous today because you actually answered very well Ankush's question. I hope that helped. Ankush, let's ask a couple more mortgage questions to Dave, and then John, I have a market-specific question for you.
Sure.
Dave, you mentioned that the market is expecting the Bank of Canada to cut rates starting next spring. Do you think that is pretty reasonable? And do you think the BOC, as you said, its sole mandate is the inflation, but do you think they are thinking about what higher rates can do at mortgage renewals, which are coming up in bigger numbers in the next few years? Or, as you said, is it just about their inflation mandate?
Well, I think there's no question that the Bank of Canada is nervous about what happens in 2025, because that's when all the 5-year variable rate mortgages that were taken out in 2020, after the Bank of Canada governor said Canadians can count on rates staying low for a long time, that's when those mortgages come up for renewal. I think, John, we did a talk here a while back, and I said, as a former hockey coach, the fastest skater in the rink is the guy who just coughed up the puck to the other team. The mess coming in 2025 is of the Bank of Canada's own making. So there's no question they feel that pressure. And by the way, it isn't just anecdotal. If you're the bank saying we need to keep rates high to slow the economy, and you know that there's a big chunk of variable rate renewals, a lot of which had fixed payments coming up for renewal in 2025, you also know the impact of higher rates is really going to hit the economy hard then. And if you're worried about bringing inflation down, you know that when that happens, the economy is going to slow. The worry for the BOC is it'll slow by too much and it'll do damage. And then ultimately they will, it's sort of like, you've got a patient on the operating table, and you want to give the patient enough medicine to cure the disease. But if you give them too much medicine, you can kill the patient. So they don't want to kill the economy for the sake of bringing inflation down. So there's no question there's pressure. But if we get to 2025 and oil prices are $125 a barrel because the U.S. is at war with Iran, then renewers be darned. I don't think the Bank of Canada is going to be cutting rates if inflation's at 5%. That's a Mars hitting Earth scenario, by the way.
Yes. Thank you. Let's see. There's one more question from Visco. Over the next 5 to 10 years, where will mortgage rates be? Wow, that's a crystal ball and then some.
Yeah. So tough to say. I don't think we're going back to the levels that we saw at the bottoms, guys. That's a question I get a lot. Are we ever going back to rates below 2%? I mean, if we have another pandemic, all bets are off. But I think realistically, the bond market right now thinks that rates are going to settle in the 3% range, and I think that's a reasonable assumption. And that would put mortgage rates in the mid 4% range, low 4% range. I wouldn't do anything today betting on rates being back around 2% 5 to 10 years from now. I think it's reasonable to believe they'll fall, but I would be guessing in a range of 1 to 2%. And a prediction now about 5 to 10 years from now, I mean, I might as well close my eyes and throw a dart at a wall, because there's so many factors that affect things, and that's so much time to pass. So really tough to, the one thing for sure, anybody puffing out their chest with a confident answer to that question should not be listened to.
All right. Thank you very much, Dave. I'm going to go to a few market questions. Welcome to Dave stay for those as well. Hi, John. New development permits in terms of freehold pre-construction has been dropping in the past 18 months. Does this also mean we may have an inventory issue in freeholds by 2025? as freehold takes about 18 to 24 months to construct. Appreciate your point of view, and that's from Riaz.
100%. I mean, we already have an inventory issue. I mean, we cannot confuse cyclical trends from longer term structural problems. Okay. Just because inventory is picking up for low rise homes, it does not mean housing supply is not an issue. It doesn't mean we have more homes than we need. It just means people are deleveraging. They're selling, the people who are over leveraged. It means some buyers who can afford today's prices at today's rates. So the underlying structural problem with housing and the shortage of housing will continue. I don't think these dynamics we're seeing in the markets today are gonna be permanent. You know, they're going to stay with us as long as rates stay in the sixes. You know, when rates were in the fours in the start of this year, I mean, the market did what no one thought it would do, and the market just went on fire. Okay, no one saw that coming, and I will say it went on fire partly because the demand was average, but partly because new listings were in the gutter and there's nothing to buy. But the point is, if rates hit the fours or high fours, we're going to have a pretty balanced market, and we're going to have still a shortage of housing. So yes, the fact that our population is growing by over 1 million and we're building fewer and fewer homes is going to be an issue that we're going to be dealing with a year or 2 or 3 from now for sure.
John, you mentioned the market went on fire. Unfortunately, it now seems that some pre-construction developments have curiously gone on fire across the GTA. Yeah. So part of that pre-construction story in terms of trouble. Let's go now to a more specific question about the market. John, you talked about it softening. So from dash to sixth, I think this is a question that maybe a lot of active buyers are experiencing. Quick update on my situation. I found a detached in the area I want, but the house isn't quite turnkey. The built-in sub-zero fridge doesn't work, and the backyard is riddled with weeds. So the house will need some redos before moving in, and I'm not sure how much to factor that into the offer. Any thoughts? I'm curious about your anecdotes on how clients have fared in this situation, pros and cons. And I guess, John, more broadly, what is the negotiation room like right now as we're seeing the market move towards buyers?
This is such an important question. And I think because I don't think most agents are used to a market like this that is slow. Most agents are reluctant to offer way under asking. I think we have a whole generation of agents who only know how to pay over asking. I mean, I'm not even picking on them. Like, that's just the market has been like that, right? They're not used to paying under asking. And the reality is this: if you're a buyer, okay, this is definitely the market where you have potentially some leverage, right? And you have leverage to lowball a home. I mean, if this house that Dash is looking at, you have to look at the entire history, how long it has been on the market. Is it overpriced? How much other inventory is there? When we're dealing with that, we're calling the listing agents on behalf of our clients to see how motivated the seller is, because some listing agents will just drop everything on the table. Like, as soon as you call them, they'll say, just bring me an offer. My client is desperate. They're distressed. They just need to move on. And that might seem irrational because, why would a seller kind of do that? Why wouldn't they just slash their price? When I say it's irrational, you would think, why are they sticking at their price if they're desperate? Why don't they just drop it? Because if you're listed for $1 million and you drop to 900, there's usually no going back. It's a lot harder. You kind of set the expectation. Whereas if you're listed at $1 million, some sellers will kind of drop their price more significantly once there's an offer on the table, right? And I'm just speaking from a seller's psychology. When we work with sellers, it's harder for them to drop significantly in terms of an asking price, because that is just the list price, right? And they think, well, I might even get less than that. Whereas if you bring, as a buyer, if you bring that seller an offer and is significantly less than they're asking, and even less than they expected, if they know accepting it means it's a done deal, they may be more willing to take it. So you know, and I'm not saying that's the case with this property. You don't know if the home's been only in the market for 2 days, you know, the seller's going to be less eager to take a big price cut. But if it's been on the market for a while, I mean, I think this is the time for where we cannot be shy to try to lowball and test the seller and see how motivated they are, and try to squeeze a little bit more money. 100%. This is, I mean, if you're not going to freaking do it now, when the heck are you going to do that, right?
All right. So very on the fence words from John. No. I think you got your answer, Dash. Hope that helps. And let's go to the last question from Visco. Again, a bit of a crystal ball question. What would the impact of 4.5% interest rate on the rental market be over the next decade if things remain in that area?
That's actually a good question, because I mean, it has multiple, there are multiple ways that impacts the market. On the one hand, 4.5 would probably see more people jump into the market as buyers, I would think, which on one hand takes potentially people out of the rental market, moving them into end users, into buyers, making them buy homes. So on the one hand, that relieves a little bit of demand for rental housing, moves it to end user occupied housing. On the other hand, if rates stay this elevated, how many investors can hold onto their rental condos paying 4.5%? And I think that's going to be the trickier part, because that the prices that people have paid more recently, the numbers are not going to work. Like, they're going to be, you know, out $1,000 a month on cash flow, or 1,200 or 1,500. And how many investors are willing to pay an extra 1,000 or 1,500 out of pocket? So you might actually see more investors. We're starting to see more investors selling their condos, which might put more pressure actually on the rental market. So I don't have a perfect answer. I mean, it can go either way, but my instinct is I think it would actually be negative. I think if rates stay 4.5% or higher, we might see more investors selling, because the numbers are going to be challenging to make rental condos work.
All right. And I think that answers Visco's follow-up question, which is, you know, over the long term, would it be better to exit the market? But my question, John, to you is, you're then measuring that against Canada's population increases, which the current federal government has tabled at 5,000 permanent residents. We know we have a lot of international students and temporary workers. So do you measure that against the question about, you know, the higher cost of carrying rental units as an investor?
Well, no, because even though you have this massive demand boom, 500,000 new immigrants, more than 500,000 non-permanent residents, the fact is there's an upper limit on what people are willing to spend for a rental, right? Like, and we're gonna start to see that. Like, it can only go so much higher. It's not like houses. Like, houses can appreciate 10% per year, partly because it's fueled by interest rates, it's fueled by capital. It is not just not just kind of the mortgage payment's a function of the interest rates, I should say. Whereas
right, but mom and dad can help, but there's a bank,
mom and dad can help. There's a lot of
there's a cash play involved.
People bringing money in from overseas, buying in cash. There's so many other factors that can contribute to rapidly rising prices, and why historically home prices appreciate faster than rent prices, right? So we could be hitting a limit. Even with the population boom, and like what will end up happening most realistically is you end up seeing multiple families moving into single family homes, for example, right? And we're starting to see that already. Like, we're getting 2 families applying to rent a home that is a single family home because they can't afford it on one family's income, right? And this is also challenging because as a landlord client, they don't want that. That's risky to them, because what if one family wants to leave? Then they're, stuck with one family who can't really afford it on their own, who's trying to find another family to kind of partner up with them. So it's not even it's a difficult situation for the tenants and for the landlords, right? So there's no great path from here, unfortunately.
All right. So thank you for that. And thank you, Dave. A lot to track over the next little while. I'm sure next month we'll hear other great questions, or maybe be able to revisit some of these issues.
Awesome. Beautiful. Thank you again, everybody, for your questions. David, thanks for joining. Urmi, thanks for manning our questions and answers in our chat. We will see everybody next month. Thank you again.